Hi everyone. I recently sat down with 3 independent mortgage brokers. Over a coffee, Peter Trethowan from Astute at Wilston, Jason Cook from Presidio Finance, and Peter Mastrioni from Loans Only gave me a bit of an update on APRA, all of the negativity we're hearing in the media at the moment around the changes to lending policies, and also gave me some thoughts on what options are still available today for people looking to buy property. Here's what they had to say.
So APRA is the regulator. They're the bosses of the banks, essentially, in layman's terms. And we've been operating in an environment of historically low interest rates. And from an investor's perspective, they've had an appetite for property, particularly in markets like Sydney and Melbourne, which we've seen boom. And the regulators are looking at that and seeing what they can actually do to influence the slowing down of those property markets, which has meant that they've influenced the lenders to really micromanage their credit policy, and that's made some pretty strong shifts to the actual policy arrangements that are now in the marketplace.
So the banks are, their hands are tied with the regulation, so they need to slow their investment lending. There's not many mechanisms for enabling that, so the key ones are to raise interest rates. So to make it harder for people to afford the investment debt, great way to slow the growth in investment lending. Secondly, they've decreased the available loan to valuation ratios. So again, whereas it might have been easier sort of 1 to 2 years ago to get 90-95% lending on property, it's now a little bit harder to do that. And for the sort of day-to-day investment loan, it might be easiest to say stick to an 80% loan to valuation ratio.
So in the last couple of months, one factor that I'm actually seeing is that a serviceability assessment is becoming more of an affordability assessment. So there's one aspect of being able to service a $1 million loan, but can the individual actually afford to maintain the payments of that actual lending facility? So I'm seeing a lot more stringent assessment of an application process, which is also reflected on declared living expenses as well, and new lenders bringing in new policies around loan to income ratios as part of their assessment as well. Very generally speaking, if you're looking at a basic home loan product, there's probably 50 basis points difference in terms of the general rates that are available in the marketplace at the moment.
Why are we seeing this disparity now?
I just think it's mainly us APRA and ASIC trying to obviously stem the investment basically lending, so they're making it harder for borrowers to borrow, which in turn is obviously it's making the rates obviously different between owner occupied and investment.
It hasn't become impossible to get an interest-only debt. It's still possible. It's a little bit harder, yes, but it's possible. So.
Yes, they are still available, and the banks have an appetite for taking on those kind of facilities and will always continue to do so. I think there's been a lot of rhetoric in the marketplace around interest-only debt structures not being in a borrower's best interest, and I actually feel that's pretty misguided. Depending on the actual individual, P&I could be viewed as a way of forced savings to maintain those repayments, but if you can maintain your household accounting budget in a realistic manner and actually set up an interest-only structure and have an offset facility, it's a far more efficient way of actually managing your investment debt.
Yeah, I think it's if you've got an existing loan and it is interest only, obviously the lenders have taken it upon themselves to increase the rates automatically. So it is obviously people's cash flow, it's making it harder for some of those people. If they're on a fixed rate loan, then so when that matures, then it opens up the whole package to have a good look around at other options for them. Because even though they're on a good rate today, in 3 years' time, that's it's maybe certainly different. But I don't think it's any need for anyone to panic at all. I think there's still some great options out there, whether it is interest only or whether it is it's principal interest. It was only probably 5 years ago the rates were well over 5%, and now you can certainly get a good rate at 4.5%. For an investor that is interest only. So I don't think it's a bigger problem as everyone thinks it is.
In the past, like you said, when an interest-only period was up, it was more of a tick and flick process. It was easy to roll them over onto a new interest-only period. But I think now, you do need to be better prepared. You need to put a lot more thought into it. This is where brokers really come into our own, because for clients that have an interest-only loan, they go back to their bank. It's not a tick and flick. The bank could say no. Everybody's policy is different at the moment, so you really need to have a great relationship with your banker or a quality investment-focused broker to get a good result at that time.
In probably more recent times, and I say the last 6 to 8 weeks, there's been quite a significant pushback on how far lenders are prepared to go from a loan-to-value ratio perspective. Most, or the majors, are going up to 80%. The vast majority are still going up to 90% on the loan-to-value ratio. The majority of my business is done with investors. It's done at 90%, and it's done on an interest-only basis. The deals are harder to get through, and I say that on probably the last 6 to 8 weeks, but there are still options available. One specialist lender will still go to 95%. They'll cap the LMI as well. A couple of lenders had a big appetite for doing bundled arrangements where they were specifically chasing after cross-securitized properties and bringing your owner-occupied and investment portfolio across and offering some pretty sharp discounting. On that, those arrangements are starting to pull back, but the majority of lenders still have a pretty big appetite for doing those kind of deals.
I think too, if an existing property owner, wants to leverage the equity in their own property, they can then, borrow up to, 100 to 110% of the purchase price plus the cost for a new investment property. So for your investor, there's no dramas at all. Still borrowing 100% of that plus your costs and still doing it interest only. Most lenders have no dramas with that at all.
We've had examples recently where people have lived even in troubled locations overseas, Qatar being the one that comes to mind, and we've still been able to find a deal at 70 or 80% loan to valuation ratio. Yes, the cost is higher than what you might find if you were working here in Australia, but you can get the deal done if you really need to.
I think for the good stable applicants who have been in their job overseas, good residential status for 3, 5, 7 years, good employment history, then the banks then are looking at them a lot more favourable than if you've just moved over there and been with an employer for 6 months. So,
lending money is a highly profitable business, and banks genuinely want to do deals. So whilst there may be restrictions that are coming in through the regulators, banks are varying their policy, and if one will bring out something that's restrictive, it's typical that brokers will receive an email blast out an hour later from a separate lender indicating that they're still prepared to do that kind of deal. So,
can you still get a deal done? Yes, you can. So the banks are very cautious around lending within super, but provided you're sensible about it and you meet the criteria, you can still get a loan done.
So I'm a strong advocate of the rent vesting strategy. I'm a firm believer that you should live the lifestyle that you would love to live. So if that means renting in a location that is desirable for you for lifestyle purposes, it certainly opens up the scope in which you're able to invest in other locations which may actually present a better investment return.
I agree 100%. I think yields in some regional towns are actually better than they are in your capital cities. So I think people still have to borrow well within their means and understand what sort of investment strategy and property they are buying.
Loans are still available. Don't let the media hype around the APRA changes scare you from making an attempt to improve your future.
Well, there you have it. Some really interesting information there. I think the biggest takeaway though is that if you really want to achieve financial freedom and you want to use property as an investment vehicle, there are still options out there today. Don't let APRA, don't let the negativity in the media stop you from contacting a good mortgage broker or contacting your financier and seeing what is still available today. For as little as $50,000 or $60,000 in cash savings or equity, we're currently helping people invest in really strong locations, affordable prices, good economic development, sustainable employment opportunities, and most importantly, as you just heard in the video, some good rental returns. If you've got any questions at all, please give us a call, 1300 65 40 70, or you can email us invest@propertyology.com.au. Look forward to hearing from you soon.